Yo, hello guys. So today I wanted to show you about the synthetic indices. Some of the trades you should have taken using SMC. So I don't clear the chart. Let me start from. I think the chart is a bit noisy, but let me demonstrate a bit without all this. Just a minute. Okay, so let me start from here. So in this demand zone, right here, we had this order block. It was a demand zone. Then we had a small liquidity sweep, change of character or CISD, change in state of delivery, then some liquidity accumulation or engineering or generation, then a tap buy. First TP was here in this small supply zone, this order block. Second TP was right here in this other zone. Then after that we had another sell. We wanted a confirmation right here, but we did not see any, so we wanted another sell from here, from there to here down, back to our zone. There was this liquidity. If you can see, a double bottom, which was a nice place for liquidity to be hanging. Then we went another sell up to this demand zone, back then, but we refined it. Then we entered a buy. Our TP was still here. Now I'm looking for this. I'm waiting for somewhere around here. Let me zoom in a little bit. I'm waiting for such a demand zone right here up, but let me clear the chart so that we can start all over again. Okay, so let me start from the start. So in the 4 hour, there was this. Where was it? In the 4, there was this demand zone right here. I'll use a rectangle for that. Well, it should have been from here, but let me use this one because, as you can see right here in this order block, it wasn't yet mitigated. You can see. Let me zoom in. You can see it was not yet mitigated right here, also right here. So this is presence of liquidity, and in the future, then in front you'll see. Let me extend it. I think it was a bit far. How many days has it been? Okay, interesting. So I marked it all from the start of the bearish candle to where the liquidity was taken right here. If I've talked about this in the previous video, I remember I said that when you're marking it, it's marked from the week to the week, or probably to the week that took the liquidity. So this is our demand zone, our point of interest. Then we scale down to the 1 hour to see if we'll see any confirmations, because you cannot enter without a confirmation. Just a minute, and yep, that's it. So here we could see this liquidity sweep inside the POI. Then after that we wait. It was a sweep. At first the market does this. Let me talk about it again. The market is on a downtrend, right? Then it comes and does that. Then you don't enter right here. This is inducing the buyers, early buyers who enter down here, to be stopped out. You can see. Okay, let me use a good example. Right here, after this, the early buyers who just enter without confirmations, would enter right here. Would enter right here. Their stop loss below this low, target way above those previous zones. So this is what they will do. Usually the market does this to trap the retail traders who do not wait for confirmation. See, the market was going down like that, so they would say, this is a change in state of delivery. They then enter here after retracement, then they got stopped out right here. So we don't want to be stopped out, so that's why we wait for a confirmation, a liquidity sweep into the point of interest, which was here right after this sweep. Then after that, the market generates its own liquidity. This is also an A+ test setup, I said once again, because if you see this, just know that it will come out of the point of interest and come and sweep this liquidity, which it did right here, and then it continues buying, right? So I'll take that out. So inside the point of interest, this was a swing trading. It was a swing trade. A swing trade, because my lowest time frame was the 1 hour. But I'll scale down to the 15 minutes for people to see more clearly. So there's a sweep there. Then right here you can see there's a change of character. And I told in the previous video that I usually don't trust a wick, I trust a body, because a wick is not a clear defined movement of momentum for buyers or sellers. So here, right here, you see that I thought, to me this is a wick, so I did not enter here. I did not mark this as my change of character, so I waited for it here again, which was nice. I want to put labels right now, but yeah. So after that, you wait for all. You can see generation of liquidity, or other people call it liquidity engineering, which it comes, creates all this, comes here back down, taps it, goes back. So let me label my lines for better understanding this. And here I think it's not a bit straight, but yeah, no, that's straight, and this is not straight. Yep, and you can see here there's presence of liquidity starting from all this. If you learn well, you'll know that right here in this, you will see something called as, let me use an arrow to show you. So after taking liquidity into the point of interest, you'll see this, it will try to take this high, and it does not, and it fails to take the low also, and this becomes a failure to take the swing low, so it becomes a protected low, and then it comes, takes this out, then it changes character, changes state of delivery. Then later here you'll see it comes and takes this out, all this liquidity right here. Your stop loss, a good entry will be here in this demand zone. With your entry there at the beginning or the start of the demand zone. Stop loss should be here, this low. Let me use a line for you to see. This should be a good stop loss. But if you want to have a better stop loss, you should put it below the point of interest, which is right here. So any can do, but I prefer to have better stop losses, but still any can do. Then I first take profit to go back to the 4 hour. The first highs. Another thing I want to tell you, you see, normally this is a high, but if you have been in the markets for some time, you'll realize that it does not take the high. You see right here, somebody would have missed all this. That's why I don't put it at the high, I put it at the demand zone itself, the supply zone, because I know I thought it would have a good reversal. My prediction was right. So you see, I'll have missed the trade. They take profit by a few pips. That's why I did not put it in the high. So my zone was here at the start of it, my take profit. That was the first take profit. No, that was the second take profit. The first one was right here. But here I put it I put here above this high for one reason. First, the main reason I had it above this high was because I knew this was not a valid valid supply zone. Let me mark it out. This supply zone was not a valid supply zone for obvious reasons. Well, we did say it had an imbalance, but it did not grab any liquidity before. You see, if you can see well, this high, let me mark it. If you can see well, pardon, a minute. If you can see well, right here, but it came down back up. You see, this did not take this high, did not sweep it, so this became invalid for me. This was just because of the oversell that happened here. This was just some buyers entering in to prevent that overselling. I'll talk about that in the next video. I don't think I've ever talked about it in here. So that's why it was not my valid zone, and I knew it would not hold, which was clearly right, because those people who entered here short got stopped out severely. Actually, it was so bad. Yeah, you see, people who entered something like that got stopped out. They were induced sellers. So that should have been your trade. TP1 smashed, TP2 smashed. That was nice. Going back again to this zone, why this zone was so valid for me, it wasn't that valid because I said it did not take that high out, but I waited for a confirmation. One confirmation was that there was presence of this liquidity. Let me erase that line. So there's presence of this liquidity, this here, chemical markets, the first one. There's presence of that liquidity, so that was another good thing, because you see, another reason why this was not so valid, there wasn't any presence of liquidity. If this I would have been somewhere like here, tapped in this fair value gap, and this probably here, it would have been a stronger one, but here it was not. That it was not so valid. Then we go back to the 1 hour for confirmation. In here I did not do a 15-minute confirmation because I would have missed this a minute. In the small one I did not do a 15-minute confirmation right here. To me this was my setup exactly like that, so I did not see any reason for having a lower time frame. My lower time frame was the 1 hour for this, but you can go to the 15-minute and see. So back here again, in the 1 hour, I went in the 1 hour and tried to see. I did not see anything clearly, so I went in the 30 minutes. Usually I don't come here because I don't see any confirmations, but let me show you. And I went in the 15 minutes. Now the sell trade, that's why I went in the 15 minutes to look for a better entry, and I saw this. Again, I'll draw the same pattern. So market is on an uptrend. Our highs, our lows, our highs. Some accumulation right here, manipulation. Again, this. So what do? You wait for a sweep. Then this sweep happened right, was it here? Let me remove the arrow. The sweep happened right about here. You see, another reason why you should not have entered here. Remember I talked about double tops and double bottoms. Let me revisit your memory. You see a double top, something like that. I said back on another bottom. Let me use the same path for it. I said something about sellers who entering in this double bottom are, I don't know, a lot of sellers have their stop losses right above here. So what does that tell you? It tells you that there's a lot of liquidity, a lot of it. The market is being attracted by liquidity. Like liquidity acts as a magnet, so that's why it's so risky to have your stop losses somewhere above there, or entering a trade when you see a double bottom or a double top. Same case with here, a double bottom. Many traders, they are buyers who entered somewhere around at the center, have their stop losses right below this, somewhere in these zones, and that's why the market sweeps them. That's a lot of traders are swept in these double highs and double bottom. So you can see this was a double high. To give you a better confidence for you to know that there will be swept liquidity. So after that, I did the SMC stuff here. I did not use my point of interest confirmation to enter. I used this old model. Let me show you. Again, that's why I say I think it's, for me, I can say it's good for you people to learn a lot of strategies so that you can specify with maybe 2 or 3 or 1. But learning a lot can help you gather a lot to add them as confirmations. Because right here, if I would have waited for this, for retracement, usually in this trade setup, I would wait for this. But here I also saw the selling pressure is too high. That I did not wait. I did not enter with that. So here, if I would have waited for something like this to tap into this fair value gap, you see, I would have missed it. So remember in the previous video I was talking about I'll work on something to prevent missing trades. So I came back to this setup that I used to do, I think 2024. I used to do 2 years ago this same stuff, but I stopped it. But now I'm trying to refine it better. You see, an inverse fair value gap with a fair value gap shows you a strong change in, let's say change of character, change of character. Yeah, so that's what I went and worked on to prevent missing my trades. And it ain't that bad because after that sweep, so this is what I did. I don't know how many of you remember this, but we used to do something like that: a sweep of liquidity, sweep in liquidity with a nice wick, then inverse fair value gap. It's nice, but having an inverse fair value gap with a fair value gap is even better because it shows you like it's like a good point of reversal. The same way that double bottom, a double top shows you a good reversal after the sweep. So this is this minute. no, yeah, right there. So this was the entry. After that, exactly enter the start of this. So your good stop loss should have been here above that point of interest, but for me I had this. It's a tighter stop loss and a more risky one, but it reduces my risk to reward ratio in my management, because I was sure. So this was a protected high for me, because you see, after all this liquidity sweep, then it sweeps it in the inverse fair value gap. Then something about the synthetic indices is that it doesn't retrace that much back like gold and BTC. Most of the time you have your missed entries. The same thing like a person who trades gold entering currency pairs, you'll have a lot of missed entries. So take profit to go back to the 1 hour. Take profit will tell you go back to the time frame, the higher time frame, to see it. So here is one. You see these double lows, some double bottoms. The first take profit should be there, and then the second one was right here in this order block. How do I refine it for you people to see? Here at the start of it. Again, as I told you, I don't put at the end of it, because usually price can use that zone you're entering at the end of it as a resistance or support level, so it reverses right before your TP. And so yeah, TP2 at the start of that look at that, a beautiful buy and sell trade. Let me minimize. You see, a beautiful buy and sell using purely SMC. So I did not mark that out, but yeah. So in this zone was supposed to be invalid, right? Let me show you something. So we came to this zone. First of all, this zone has already been mitigated right here, so you don't expect it to be valid anymore. That's why it was fake. Let me say it was fake. It was invalid at the start. Also, we did not see any change of any liquidity sweep or change of character, CISD, break of structure. We did not see nothing right in this zone, so it was nobody should have entered a sell right there if they know what they are doing. Yeah, a buy confirmation for this. I did not also see it, but it looks nice. I'm pretty sure some people had this, but it does not align with me. I did not see it actually, but yeah, that was nice. This was nice also. Targeting that high. If it's mitigated once, usually it does not come to mitigate it again, so you can put above that high. Yeah, you see. But let me scratch that. Yeah, so I'll write down some of the notes. Remember, point of interest. Minute. Oh, yeah. What's happening with my laptop? Point of interest. So you look at the point of interest in the 1 hour, the 4 hour. Why is it blue? Never mind. No, I think I'll change it to black. I don't like the blue stuff. Then smaller time frame. If it's the 1 hour, usually scale down to the 5 minutes. If it's the 4 hour, I usually scale down to the 15 minutes. Let me add it in case someone doesn't confuse. Yeah, so that's the stuff. After that, you wait for liquidity sweep. After that, you wait for change of character, or you can say change in state of delivery. This is for the CRT traders mostly, and the first one is for the SMC traders. After that, you wait for liquidity generation or engineering. How will I say it? Liquidity engineering is a better word. Then you enter at a demand or support zone. Demand / supply zone. Then the TP in the higher time frame. Yeah, it's basically it. It's so simple. Keys, you wait for confirmation. All this is confirmation. Yeah, that's actually the main thing about here. It does apply the same. Usually I don't do this. I don't trade in these synthetic indices, but for people who wanted to trade, who are asking in the community about this is how you go about it. I don't like it, but it's not bad. For a beginner, you can use it actually instead of going into gold. then you can go into proceeding to USD, GBP/USD, then to GJ, UJ, then maybe to US30, then maybe to gold at the end. But yeah, as long as you're making money, who cares, brother, who cares? So it was a nice time. Thank you. Follow for more.